3 milliseconds. That's all it takes for an algorithm to make or deny money that most people will never even see. Right now, while you're watching this, machines are buying and selling assets faster than human thought. Not smarter, faster. And that speed alone is quietly separating those who get richer from everyone else. This isn't about talent. It isn't about education. And it definitely isn't about working harder. It's about access to an algorithmic advantage that most people will never touch. Over the last 2 decades, financial markets have been transformed. Trades that once took minutes now happen in microseconds. Human traders didn't disappear because they were bad at math. They disappeared because they were too slow. High-frequency trading algorithms now execute the majority of trades in major stock markets. These systems scan prices, predict movements, and act before a human even realizes something changed. The result? Tiny price differences, invisible to ordinary investors, are harvested millions of times a day. Individually meaningless, collectively worth billions. And here's the part few people talk about. To even compete, you need infrastructure. Servers placed physically closer to exchanges, private data feeds, custom-built algorithms costing tens of millions to design and maintain. If you don't have that, you're not playing the same game. Most people still believe markets reward insight and patience. But what if the real divider isn't knowledge, but proximity to code? And if this algorithmic edge reshaped finance, where else is it quietly deciding who pulls ahead and who falls behind next? Picture 2 investors. They see the same price, the same stock, the same moment. One clicks buy, the other never even sees the opportunity, because between those 2 actions, an algorithm already moved. This isn't hypothetical, it's structural. Modern markets are fragmented across dozens of exchanges and trading venues. Prices don't update everywhere at the same instant. They ripple, microsecond by microsecond. High-frequency algorithms are designed to detect those ripples and act in the gaps. This is called latency arbitrage, and it's legal. If a stock ticks up on one exchange, an algorithm can buy it there and sell it milliseconds later on another, before the new price fully propagates. No prediction, no long-term bet, just speed exploiting delay. Humans can't do this. Even professional fund managers can't, and regulators know it happens. In fact, market rules themselves allow it, as long as trades follow disclosure and access requirements. Speed isn't restricted, it's sold. For co-located servers for direct access, so the market doesn't just reward speed, it monetizes it. Supporters argue this adds liquidity and narrows spreads, and sometimes it does, but the benefits aren't evenly distributed. The firms capturing these micro-profits operate at massive scale, turning fractions of a cent into enormous, consistent returns. Here's the uncomfortable truth. You can understand the market perfectly and still lose to someone who simply receives information first. So if wealth can be extracted without insight, only infrastructure, what happens when the same logic spreads beyond trading into everyday life? The same pattern is already spreading, not just in finance, in jobs, in housing, in credit. Algorithms now decide who sees opportunities first, or at all. Take hiring. Large companies don't read every resume. Algorithms filter them. They rank candidates before a human ever looks. The criteria are based on historical data, past hires, past performance, past success. That sounds efficient, but it has a side effect. If certain groups were advantaged in the past, the algorithm learns that pattern. It doesn't intend bias, it replicates it at scale instantly. Now zoom out. Credit scoring models determine loan rates. Pricing algorithms adjust rents in real time. Recommendation systems decide which creators get visibility and which never break through. In each case, early advantage compounds. Those already ahead generate better data. Better data trains better models. Better models reinforce advantage, and access matters again. The most powerful algorithms aren't public. They're proprietary, owned by firms with the capital to collect massive data sets, hire elite engineers, and run models continuously. If you're outside that loop, you don't just lose efficiency, you lose visibility. You might apply for the job, but never reach the shortlist. You might list the apartment, but never reach the top of the feed. You might create value, but never trigger the algorithm. This is the quiet shift. We're moving from a world where effort competed with effort to one where systems compete with systems. And if algorithms now shape opportunity itself, who designs them, who controls them, and who they're optimized for, becomes the most important question of all. Because once decisions are automated, reversing inequality isn't just political, it's technical. Here's where the gap quietly widens. Algorithms don't just make decisions, they learn from outcomes. And that feedback loop is where inequality accelerates. When an algorithm allocates resources, capital, attention, opportunity, it measures what worked. Then it optimizes for more of the same. That's the logic cold. Efficient, relentless. In finance, profitable strategies get more capital. In advertising, high-performing audiences get more exposure. In education platforms, students who engage early get better recommendations. The system isn't asking who needs help. It's asking what converts. This is known, studied, and documented. Optimization systems tend to favor users who already show signals of success because they improve performance metrics, clicks, returns, completion rates. Over time, the algorithm doesn't just reflect inequality. It amplifies it, and humans rarely see this happening because decisions are distributed across millions of micro-choices. No single moment feels unfair, but the aggregate effect is powerful. Researchers have shown that even small advantages at the start, slightly better credit terms, slightly more visibility, slightly faster access, compound dramatically when fed back into automated systems. The rich don't just earn more, they generate better data. And better data makes the algorithm work better for them. This isn't malice, it's math. But here's the turning point. Once systems are optimized for outcomes rather than fairness, correcting inequality after the fact becomes extremely difficult, because the algorithm is doing exactly what it was built to do. So the real question isn't whether algorithms separate people. It's this: can systems designed to maximize efficiency ever be trusted to produce equity? Or is that a contradiction built into the code itself? For a long time, this separation was invisible. You couldn't point to a single villain. No law changed overnight. No announcement was made. But the consequences are now measurable. A small number of firms capture a disproportionate share of profits in algorithm-heavy industries. In markets dominated by automation, returns concentrate. Studies in finance, tech, and platform economics show the same pattern. Scale plus algorithms favor incumbents, because once an algorithm works, it's deployed everywhere. One trading strategy becomes thousands of servers. One pricing model sets millions of prices. One recommendation engine shapes global attention. And the cost of entry keeps rising. To build competitive algorithms, you need data. To get data, you need users. To get users, you need visibility. And visibility is often controlled by algorithms. This creates a barrier that isn't obvious, but it's real. Traditional competition assumed skill could catch up. Algorithmic competition assumes capital comes first. That's why smaller players don't just lose. They're never seen as competitors at all. They don't generate enough signal for the system to notice. Even governments struggle to keep up. Regulation moves slowly, algorithms adapt instantly. By the time a rule is debated, optimized systems have already shifted behavior within its boundaries. So the divide isn't only rich versus poor. It's those who can shape the systems and those who are shaped by them. And once you realize that, one unsettling thought follows. If algorithms are already deciding outcomes at scale, quietly, legally, efficiently, what would it actually take to change their direction? Because understanding the problem is one thing. Rewriting the incentives behind the code is something else entirely. There is no single switch to turn this off. Because algorithms don't exist in isolation. They follow incentives. If success is measured by speed, systems optimize for speed. If success is measured by profit, systems optimize for profit. If success ignores distribution, distribution is ignored. That's the uncomfortable reality. Some responses are emerging. Regulators now study algorithmic transparency. Researchers push for auditability, ways to test systems for unfair outcomes. In finance, speed bumps and disclosure rules have been introduced to slow the most extreme advantages. In hiring and credit, laws increasingly require explainability. But none of this changes the core dynamic. As long as algorithmic power depends on capital, data, and compute, advantage will concentrate. Not because the code is evil, but because the environment rewards scale. And here's the final tension. Algorithms are not going away. They're becoming more embedded, more invisible, more decisive. The real divide forming isn't between humans and machines. It's between people who can influence how systems are designed and people who only experience their outcomes. That's the algorithm separating the rich from everyone else. Not by conspiracy, not by intent, but by structure. And once separation is structural, the hardest question isn't whether it exists. It's whether we noticed it early enough to do something about it.